Good morning. We're ready to go into chapter 8 in Accounting 230. And I hope you're seeing the slides. I don't know why this thing isn't sharing. Brings that up, okay. Having trouble sharing, guys. I want to share with you. Okay, there are the PowerPoints. Now share, darn it. Oh, thank goodness. Okay. All right, it's about 11:07. I wasted about 5 minutes of our time here. I'll try to delete that from the taping. All right, here we go. Analyzing receivables. Now we're going to get into the different elements of the balance sheet and the income statement. Learning objectives, how companies recognize accounts receivable. Amounts due from individuals that are expected to be collected in cash, Accounts receivable, what customers owe us. Notes receivable, what borrowers owe us. And non-trade could be interest, loans, advances to employees, all kinds of different things. And I don't know why they're presenting this grid here, but I thought this was a little bit interesting. Ford Motor Company, 43% of its assets are in the form of accounts receivable. Intel, it's only 3%. I'm not sure if that's good or bad. I think if you have low receivables, that's a good thing. It means you're turning your receivables around quickly. So that's just something to provide food for thought, I guess. Recognizing accounts receivable. You recognize a receivable when you perform the service on account, and we know that already. Merchandisers record receivables at the point of merchandise on account. The seller may offer a discount to encourage early payment, and the buyer may return goods found to be no good. Sales returns reduces receivables. Assuming Jordache sells some merchandise for $1,000, there's our simple journal entry. Debit to receivables, credit to sales revenue. If the goods were returned, if Polo returned them to us, we're Jordache, we have to reduce our sales and accounts receivable with this journal entry. We have to debit sales returns and allowances and credit accounts receivable. The reason we debit sales returns and allowances is because you never debit sales. You will never, ever debit sales. but we have to reduce the net sales and we have to reduce the receivables by the use of that contra account. And then then they get paid. They get paid and the customer took the discount, 2% discount. I think we're good with that. Debit cash, debit the sales discount because that's a reduction in our sales. And they settled the entire $900 accounts receivable debt with that $882 payment. Some retailers issue their own credit cards. Assume that you own your own JCPenney card to purchase clothing. Credit cards are cash as far as I'm concerned. That should really be a debit to cash or credit to sales revenue, but that's okay. If you still owe the $300, JCPenney's charges interest of 1.5% per month. Wow, that's 18% a year. JCPenney makes an adjusting entry to accrue that interest. They debit accounts receivable for $2.25 and they credit interest revenue $2.25. Wow, that's a lot of interest. Here, Wilton sold merchandise on account to Bates for $50,000, and Bates returns merchandise with a sales price of $2,000. Okay, here's the sale, the debit to receivables and the credit to revenue. And now here's the return of $2,000. Wilson receives payment from Bates for the balance due. So this guy owes us $48,000 right now. And he paid us in time to take the 2%, or rather, wow, a 3% discount. Woo. Boy, if anybody's willing to give you 3% for holding up the money 30 days, it's well worth it. That's about 40% a year. So he receives his payment. He credits accounts receivable because the entire debt has been settled, right? He debits cash for the amount of cash he actually receives, and he debits sales discounts. How do companies value their accounts receivable and record their disposition? Here we get into a little bit of a tricky area, okay? Accounts receivable are valued at net realizable value. Uncollectible accounts receivable. When we say net realizable value, we're saying trade receivables or accounts receivable minus an account called allowance for doubtful accounts equals net receivables. And that's what we're going to go into in a second. Accounting for uncollectible accounts. We know that our customers aren't all going to pay us. Some customers will never pay us. They're crooks, or they went out of business, or they genuinely don't have the resources anymore to make the payment. We have to write these people off. And one method is to just wait until we know who was the bum and then write them off. That's the direct method. We don't attempt to anticipate anything. We just wait until there's a bad debt and then record bad debt expense. But there are better methods. And the best one is the allowance method. We are going to match our revenues and expenses as best we can by estimating the amount of bad debt expense we expect out of the current receivables. And this is a requirement by GAAP. Direct write-off is not a GAAP item, and that could force you to have the auditors give you an unqualified opinion or a qualified opinion. Reporting accounts receivable. Now take a look at this new account. You're seeing this for the first time. This is called the allowance for doubtful accounts. It is a contra asset account. It's a contra receivable. It means that it is an asset account, but it has a normal balance of credit. So whenever you increase the allowance for doubtful accounts, you're decreasing the net receivables, the net trade receivables. So let's just peek at this for a second. You have an account called allowance for doubtful accounts. Your net receivables would be 500 minus that 25. Reporting, let's see what they have here, balance sheet. Now here's how it's presented on your balance sheet. You're going to see cash, I guess, first, and then accounts receivable 500 minus that 25 we just discussed equals 475. Net receivables, net receivables. And here they're showing it without the detail. They're showing it with no detail. They're just going straight to the 475. I've never seen it done like that before. Okay, here we go. Well, we have a sale for $100. And we collected $333 against that sale. So that brings the balance down to 267. We have a typo here. We have a beginning balance of 500, then a sale of 100. That number should read 600. So that's another bad slide. So here we have 500 plus 100, which we know is 600, and we collected $333. We credit accounts receivable, and we come up with that new balance there. We're going to debit cash. Now, take a look at this. We are making a guess that our bad debts are going to be $15. Okay, we're making an estimate. This estimate you see here, in which you debit bad debt expense and you credit allowance for doubtful accounts, is done just once a month. It's a new, oh, excuse me, sorry. This is a new adjusting journal entry for you. We debit bad debt expense, we credit allowance for doubtful accounts. This is done, like I said, just one time at the end of the month. It's based on some certain statistics. When we write off a debt, when we write off a bad debt, now we're going to credit accounts receivable, as you can see, and we're going to debit that allowance. That's what that allowance is for. That is an allowance that can only be spent on reducing accounts receivable, okay? Another way to try to learn it is if you see a credit to allowance for doubtful accounts, the debit is automatically bad debt expense, no exceptions to that. If you see a debit item on allowance for doubtful accounts, you know the credit is accounts receivable. So try to get familiar with how the allowance for doubtful accounts plays into the whole chapter. And they're doing more of this net realizable reporting. And they want us to talk about the direct method. Assume Ward and Company writes off Duran's $200 balance on December 12th. Here's the entry. Bad debt expense, credit, accounts receivable. This is not acceptable for financial reporting unless bad debt losses are insignificant. In other words, you must use the allowance for doubtful accounts for all reductions of accounts receivable. Hi, Laura, welcome aboard. I know one of us is working right now, huh? Okay, direct method for uncollectible accounts. Now, here we go into the guts of the allowance for doubtful accounts. We have to estimate the uncollectible accounts receivable. We have to estimate it. We have to come up with a number. And once we come up with that number, we're going to write our one entry per month where we debit bad debt expense, credit the allowance. And that allowance for doubtful accounts, Laura, is a contra receivable account. At the time when the account is written off, you debit allowance for doubtful accounts, credit accounts receivable. So let's take a deep breath and review this slide again. You only have two-line journal entries to worry about when it comes to handling receivables. You are going to debit bad debt expense and credit the allowance in advance. And then when you find out who the non-payer is, you're going to use that allowance by debiting it and crediting accounts receivable, okay? Crediting accounts receivable. So let's continue along here. Now, here's the allowance method for bad debt expense. Hampson Furniture has credit sales of $1.2 million. 200,000 remains uncollected at December 31st. The credit manager estimates that 12,000 of those sales will prove uncollectible. Boy, that's a big number. But anyway, so they have to say to themselves, we have $200,000 in receivables, but we think 12,000 will not be collectible. We have to recognize that expense now in the month where we made those sales, not in the month when we're actually going to write off the bad debt. So at the end of the month, we'd be required to debit bad debt expense, credit allowance for doubtful accounts. And that's how it would look on your balance sheet. You'd see that line, accounts receivable, less allowance for doubtful accounts, and that gives you net receivables, in this case of 188. Now we're into a new month, and Hampson writes off $300 owned by R.A. Ware. Now we know who the bum is. We're not estimating, we know who the guy is. So we are going to write off the bad debt with a debit to the allowance for doubtful accounts and a credit to accounts receivable. Debit to the allowance account, because that's why we set it up, and credit accounts receivable. We could have a recovery, though. We could have a recovery. Suppose Wade actually 6 months later actually pays it. What if he pays it after we wrote him off? Well, that's very easy. We simply add him back to the accounts receivable and credit the allowance, put the money back in the allowance, and then accept the cash from him. Debit the cash, credit the receivables. Note disclosure of the allowance method. Here we go. Now we're going to use the allowance method based on percentage of receivables. We're going to look at our accounts receivable, and we're going to determine, based on how old the debt is, how much we expect to lose to bad debt expense, okay? The amount of bad debt expense to be recorded is the difference between required balance and existing balance in the allowance account. So that's a little unclear. I'll get into that in a moment, okay? All right, let's look at our accounts receivable aging, huh? We have an aging with a total of $39,600. Of that amount, 27,000 is less than 30 days old. It's not due yet. Then some of it lapses out to 1 to 30. Others go out to 31 to 60, 61 to 90. So there are some people who haven't paid us for over 90 days. This company makes an assumption that for any invoice not yet due, they're going to lose 2%. If it's 1 to 30, they're going to lose 4%. 31 to 60, 10%, etc. So they do that multiplication, and they come up with the total estimated allowance. Now, that's not the bad debt expense. This is the confusing part. This is where you're going to get mixed up a little bit, I think, until you do a little bit of the homework. This amount that we calculated is the desired amount we want in the allowance account. It is not the bad debt expense. It's the desired account we have to have, that desired amount we want to have in the account. So let's take a peek here. They came up with the number of 2228, right, Laura? 2228. That's the amount we want in the balance. There was an original amount there sitting of 528. So your adjusting journal entry is 1,700. I'm going to go over that one more time. The amount that they calculated here is the balance we want in the allowance account. How much was in the allowance account to begin with? 528. Therefore, we need to bump it up $1,700. Debit bad debt expense, credit the allowance for bad debts. That's one of just two-line journal entries you need to worry about. And they're just showing you here in the form of T accounts what's going on, okay? You debit bad debt expense and you credit the allowance for doubtful accounts. Assume the unadjusted trial balance shows allowance with a debit balance Well, they're just showing you what happens if it's a debit balance. It's just going to cost you another 500 to bump it up. Skechers, bad debt expense. Rule, company's been in business 5 years. The unadjusted trial balance at the end of the year shows receivables, revenue, allowance for doubtful accounts. Bad debts are estimated to be 10% of receivables. 10% of receivables. Prepare the necessary journal entry. Well, 10% of the receivables is $3,000 plus the 2,000. Let me see. What are they're confusing me for a split second. Okay, I fell into the little trap I warned you about. The balance is already $2,000. $2,000. We want to come up with a balance in there of 3,000. So we put in a journal entry for the difference. Let's talk about selling our receivables to a factor. Some companies do this in order to get paid immediately for their receivables. Factors buy receivables from businesses and then collect the payments directly from the customers normally. And they charge a commission to the company that's selling, and they're saying the fee is around 1 to 3%. I don't know about that. Henderson Furniture has 600,000 receivables, but they don't want to wait 30 days, 60 days, 90 days, whatever it's going to take to collect all of that 600. So they make a deal with federal factors. They say, look, how much will you give me for my $600,000 worth of receivables? And the factor, oh, sorry, Laura, excuse me. And the factor says, okay, we'll give you $588,000 in cash right now. So you're happy to get your 588, and you turn those receivables over to the factor, and the factor collects them, and they also collected your $12,000 service charge expense. National credit card sales. Retailer pays the card issuer. Here, when you use it, when a customer of yours uses a credit card, you are not going to get the full amount in payment. In other words, I go into 7-Eleven every morning and I buy my jug of soda for $2. I use a credit card. Well, 7-Eleven is not going to get $2 from me. They're only going to get $1.90 because Visa takes out a dime, and that's another reduction of your gross sales. And obviously, credit cards have a lot of advantages. You don't have to worry about investigating the customer. It opens up your market to everybody who has a credit card, and you get your cash right away. So here's a credit card sale. Anita Ferrari bought $1,000 worth of sound equipment from her restaurant from Kerr. So she used a Visa card. So Kerr Music is not going to get $1,000 because they have to immediately pay a 3% fee, which Visa will deduct. So the debit is to cash for $970, debit to $30, and a credit to sales revenue. Like my soda this morning, $2 in $1.90 in cash, 10 cents in the charge for service charge, and $2. Factoring. Kelly Wholesaler needs to raise $120,000 in cash to cover next month's payroll. It's reached its debt ceiling. Its balance of outstanding receivables totals $750. They decide to factor just a portion of the receivables. So they go out and they say, who wants to buy $125,000 worth of receivables? And Kel found somebody to do it. So Kel gives up $125,000 in receivables in exchange for getting paid $123,750 right now. And the difference is a service charge expense. Factoring. There are companies who do that regularly, factor. They're playing the game that they can get their money sooner. They can build it up more quickly than the service charge expense reduces it. Recognize the value and dispose of notes receivable, huh? A note is different than an accounts receivable. Accounts receivable, there's no written contract. It's all based on the faith and the full credit of both parties. A note receivable, though, when you borrow money, you're signing a promissory note. It is a written promise to pay a specific amount of money at a specific date for a certain amount of interest. And notes may be used when lending money. When credit period goes over limits, you might turn your customer into a note, and settlement of accounts receivable. So there's a note, huh? That's a nice clean look at a note. The amount of the note is $1,000. It's due in 2 months, and it's paid to the order of Wilma Company, and they're going to have to pay it back. And Wilma's going to have to pay it back in 2 months at 12% interest, or 1% per month. To the payee, the promissory note is a note receivable. To the maker, it's a note payable. Determine the maturity date. The maturity date of a promissory note may be stated on demand, on a stated date, or at the end of a point in time, and no terms are expressed in months and days. So let's take this. When counting days, omit date note is issued, but include the due date. So what are we talking about here? We have a formula: face value of the note times the interest rate times the percentage. We have a $730 12% note. $730 times 12%. Keep in mind, whenever you see an interest rate, it always represents an entire year. An entire year. This note is only 120 days. So they're saying 730 times 12% times 1/3 of a year. They're saying times 120 days. 120 divided by 360. They're using 360 instead of 365, just to be clear, I think. And there's your interest, 29.20. If it was a 6-month note, it would be here, this one for 1,000 times 9% times half a year. If it's due in a year, there's nothing to take out. So get familiar with that formula. I know you remember seeing it in grammar school, but it is a key element in doing these calculations, okay? Recognizing notes receivable. We wrote a note, and the entry that Wilma would repair, Wilma loaned money. The entry that Wilma makes for the receipt of the note. You debit accounts, notes receivable. Notice I said accounts receivable, notes receivable, and credit accounts receivable, okay? So what's happened, here's what happened here. Wilma had a customer, Calhoun, and the guy wasn't paying. And the customer apparently said to Wilma, look, turn my accounts receivable into a notes receivable, and I'll pay you later on with interest. And companies do that all the time for a couple of reasons. One, they're willing to take the risk that the guy will pay and pay with interest, so there's nothing to lose by doing this. And secondly, if the guy did go out of business, note receivable people get paid by before accounts receivable in any liquidation or receivership. Valuing notes receivable, they're valued obviously at their net realizable value. Estimation of cash receivable value, realizable value, and recording bad debt expense and related allowance are similar to accounts receivable. Notes may be held to their maturity date. The maker may default, and the payee must make an adjustment to the account, and the holder speeds up the conversion to cash by selling the note receivable. Just like you sold your receivables, notes can be sold in the open market, just like a stock. Disposing of notes receivable. A note is honored when it's paid. It is an honor to accept your payment of the note you owe me. It's dishonored if it's not paid at full time, or the dishonored notes receivable are no longer negotiable. Here we honored. I like the word paid. Okay, so Higley now, okay, I just wanted to read that real quick. Walder loaned money to Higley, and Higley's now paying it back. How much were the notes receivable? $10,000. What was the interest rate? 9% a year for 5 months. June, July, August, September, October. 10,000 times 9% times 5 months equals $375 in interest. And thus the total cash payment that Higley must pay is the $10,375. Now, during the year, we hold the note, huh? We hold the note. We're going to have to accrue the interest receivable. We're going to have to accrue the interest revenue. So we have a situation here where suppose that Wolder Company prepares statements for the 30th, and there's an adjusting entry is for 4 months. In those 4 months, they earned some interest, $300. They have to record a journal entry, debit interest receivable, credit interest revenue. Let me see if I can make that clearer. Somebody borrowed money from us at 12%. They borrowed the money in December. That money accrues interest at the rate of 1% per month. Therefore, at the end of January, we're going to take 1% of, say $10,000, which is $100, and we're going to debit interest receivable, credit interest revenue. And we're going to do that every month for 12 months, so that at the end of 12 months, we have the $1,200 in receivables sitting there. And when they pay us back next January, the money will be there to be applied, okay? Honoring the note, honoring the note. Here, they're paying us with the interest. The only difference between this and this is they had the interest revenue mixed in there. So here they're showing us cash, notes receivable, interest revenue. Going back to here, what they did was they had not accrued any interest yet. Here they've accrued the interest and they had that interest receivable account set up. So the notes I don't think are too tough. Now what note is dishonored? Higley Company indicates it's not going to pay us. If it does expect eventual collection, would make the following entry at the time. All you can really do with it is put it back into accounts receivable and credit notes receivable and include the accrued interest in there too. It's sad when the customers can't pay, huh?
Is it because notes receivable have a longer term?
It's
to be
yeah,
paid?
notes receivable has, yeah, typically notes receivable can be anywhere from 1 month to 30 years, Susie.
Yeah, with the interest
yeah.
then.
So the reason you turn an accounts receivable into a note is to take a little bit of a gamble that this guy will pay you.
Yes, eventually.
If you give him time. He says, look, give me time and I'll be able to pay you plus the appropriate interest. That's why you do it.
Yeah.
And then if that company went out of business and they were dealing out those assets, you as a holder of a note get priority over accounts receivable. You are what's called a secured creditor, and accounts receivable are unsecured. They have no protection, okay?
Okay, okay, that makes sense. Yeah.
So recognizing notes receivable. We accepted from Leonard Company a 3,400 90-day 6% note dated. The note matures on August 8th. What is the note Gambit's going to make on August 8th when they hopefully get paid? They're going to credit notes receivable because that's the amount they loaned. They're going to calculate the interest, 3,400 times 6% times 90 days, $51, debit cash. Not too tough on that, huh, Susie? Yeah. We're up to the presentation of principles and the principles of receivables management. Oh, this should be exciting, huh? Financial presentation of receivables. Here, they're showing you receivables from their subsidiaries, then their trade receivables, and everything that is a receivable, but I don't see any notes receivable in there. 5 steps in managing receivables. You want to figure out who you give the credit to, establish a payment period, monitor collections, evaluate the liquidity, accelerate cash. This is a long-winded way of just discussing how you give out credit in the first place. You have a customer who wants to do business with you. Well, first thing you're going to do is verify their credit. You're going to check in with their bank. You're going to check in with some references. Then once they're your customer, you're going to tell them, look, you got to pay me. Our payment period is 30 days. And you're going to monitor those collections. And you're going to keep evaluating how strong your receivables are, okay? If the credit policy is too tight, you're going to lose sales. If it's too loose, you're going to have people not paying at all. Believe it or not, companies want to have some bad debt expense. If my company, Lori, you have a company that is worth $1 million. My company's worth $1 million, and we're competitors. We're in the same general industry. I have a strict policy this year. I am not going to sell to anybody unless I know they're going to pay me. So I'm only going to sell to IBM and big companies that I know can pay. You loosened your policy to take some risks. At the end of the year, I had 0 bad debt expense, but you had $100,000. But guess what? My sales only grew to maybe $1.5 million. Your sales went up to 3 million because you were willing to take a risk. You were willing to risk $200,000 to make an extra 3 million. So that's why you don't want the credit policies to be too loose. If you're not experiencing any bad debt expense, you might want to take a look at your credit policy. Companies should require a payment period. We'll skip through this. We want to prepare an accounts receivable ledger. That's this thing here. Prepare an accounts receivable aging schedule. We've seen what that looks like. And we're going to calculate the turnover of receivables, huh? It measures the number of times on hand a company collects receivables. So let's take a peek. Here is another metric that I'm sure will be on your test. It's called the receivables turnover. Notice what we're doing, Laura. We're taking the credit sales, which in this case are 34,350, the net credit sales divided by the average receivables, meaning the receivable balance at the beginning of the year, the receivables balance at the end of the year divided by 2. We're taking the credit sales divided by the average receivables, and we're getting a turnover. And that turnover is 9.9 times. But if you go into a meeting and talk in terms of turnovers, people aren't going to know what you're talking about. You know, at the end of the month, there's usually a meeting with the accounting bosses, the engineering people, purchasing, sales, upper management. So what you want to do is not talk in terms of turnover, but talk in terms of words people understand what your day is. Divide a year, 365 days by the turnover, and that gives you 36 days. So what this means, Laura, is this company collects in 36 days their cash, almost 37 days. They collect from the time they bill the customer till the time they get paid, they collect in 37 days, which is pretty darn quick in my world, okay? So let's study that metric. And why are cash receipts sold? Maybe for the size, maybe the only reasonable source of cash. Billing and collecting are also time consuming. Here is the receivables cycle. Determine who to extend credit. Make sure that person knows it's 30-day terms. Monitor the collection. Is the person paying us? And you keep that analysis going all month long, and then you accelerate the cash receipts dramatically. Okay, they're giving us a problem here on the receivables turnover. We decided that the receivables turnover are the credit sales divided by the average inventory. So LeBron James, I've heard that name before. I can't place the name. LeBron James. I forget who he is. Anyway, LeBron James had credit sales of 923,795, and it had a beginning AR and ending AR of these two numbers. So how do we do the calculation? They're not going to show us, but we'll go over the calculation. The sales were 923,795. And let me just back up because I think it's important. Here is how you do the calculation once again. Credit sales divided by the average turnover, by the average receivables, gives you the turnover. You divide that into 365, you get the number of days. Okay. And you know that I don't go into the international world much, other than urge you just to read through it, though. Just read through it and concentrate on the differences between GAAP and European accounting rules. Okay. And here they're saying internationally receivables with this different characteristics are reported separately. And in our world, we don't do it that way. So just look at those differences. And that takes us to the end of our discussion. Anybody got questions? Laura, how you doing there? You okay? Poor Susanna going back and forth.
Yeah.
Can you hear me, Susie?
Yeah, my signal is on and off because I'm in the field. I'm dealing with water samples.
You're digging a well, huh? Oh my goodness. You know, where are you? Are you locally?
I'm in Carpinteria right now.
Oh, okay. Yeah, there's a lot of water, I hope, in Carpinteria. Okay.
Yes,
well,
a lot of pot.
Yeah. So what I announced at the beginning, Susie, was that yesterday I did the video for chapter 7. Okay.
Yes.
And that video is up and available for review. Now we've done chapter 8 today, and we're formally caught up. When I had that bad foot, and that set us back one day and kind of ruined the schedule. So we're on such a tight schedule.
I hope so. Yeah, right.
Yeah. So anyway, you got any questions, Susie?
No, I did the homework for this chapter.
Oh, good.
And then do you have the lecture on Saturday morning?
Saturday morning? Yeah, I'll be tutoring Saturday morning.
Okay, then I'll connect because that's the pre-test and test, and that's important. Okay. So and is it going to be from the 8th, 7th, 6th, and 5th lesson? The test.
I'm not sure. I don't know off the top of my head, and I apologize.
Okay. Oh, it's okay.
You have to look into that's more Cornelia scheduling the test. Okay. So you have to look in Canvas, and it'll tell you that.
I will.
I'm tutoring tonight at 4:00 too, if anybody's interested. So
I cannot make it that early, but yeah, I'll see as I come home what is going on there. Yeah.
Okay. Well, I look forward to seeing you on Saturday then. Okay.
Thank you. Yes, absolutely. Thank you so much.
You take care.
Have a great day. Bye-bye.
Thank you. Bye-bye. You take care, Laura. Okay.